Today is Monday, February 12th, and this is the ADM Investor Services Monday Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Alan Bush, ADMIS's Senior Financial Economist, and Mike Niemiec, ADM Investor Services Grain Analyst. Mike, let's start with the grain markets this morning. It looks like we're off to a firm start this week for oilseeds and grains. What can you tell us about these markets?
Well, it's been kind of an interesting week in the sense that we had a USDA report last week, and for 2 weeks or 2 months in a row, being the January report and the February report, we found out as far as fundamentals go, we've had the USDA go and lower exports for both the wheat and the beans, raise carryouts for both, still have an adequate carryout for corn, and fundamentally you would think that they'd be non-bullish. And so, in other words, we started out the week on a firm note, I think, on two things. Number one, we'll talk about South American influence, and then number two, talking maybe a little bit about money flow.
Are there some price ranges that traders should be watching right now?
Well, when you go and talk about the money flow that we have going on right now, it still seems that the funds are coming out of their net short positions in corn, wheat, and soybeans, and they're also adding to a sizable, again, net long position in the soybean meal. So I guess if we're looking at what we're talking about price ranges going to be here, is that with that carryout number that came out for beans being over 500 million bushels, that where we're at with July beans right now at 1020 plus seems a little bit pricey. But the problem is that South America doesn't have enough hedging pressure coming into the marketplace. And if these funds that are still net short want to continue to cover, we don't have that lip over the marketplace to kind of constrain them. Having said that, when you talk about wheat and corn, we've got a wheat and a corn contract as being at less than $5 wheat and less than $4 corn. But the type of carryouts that the USDA gave us, to try and get above that, that seems a little bit optimistic. But once again, it's all about getting hedging pressure in here from South America and how much more of these funds want to cover still being net short.
You mentioned South America. What's the latest in weather in South America? Are there any problem areas?
Well, the problem with the weather, getting back into the hedging, is that the Argentinian farmer is still more or less reluctant to go and sell because he doesn't know what his crop's going to be. As a result of the Argentinian crusher not getting soybeans, what's happening is that there's not meal and soybean oil availability on the street. So what's happening right now with the meal, that business is coming back over here. And then as far as the Brazilians go, their farmers are a little bit slow in harvesting their crops, so we're not getting the hedging there. So the weather forecast going forward is still the favorite word for a trader as far as being in the U.S. or down there. They want to see a soaker. They don't want to see spotty rains.
Alan, everybody's talking about the stock market after what was a very volatile week last week. You've been bullish these indexes for a few years. Does the recent decline shake your confidence in your long-term bullish outlook?
No, it does not. Of course, it does not look good, does not feel good. But according to the work that I'm doing, this is not the beginning of any new long-term bear market in the indices. So I believe that we'll stabilize in this area and start a new leg higher across the board in all of the stock index futures.
On Friday, Congress voted to end the brief government shutdown, and now we're funded through March 23rd. How does this affect Fed policy?
Well, in theory, the partial government shutdown would slow the economy, and that could cause the Fed possibly to delay their rate hike sequence. But in fact, it would only be minimal if in fact, it was come to pass to some type of shutdown, which of course was not the case. So the Fed still appears to be on track to hike rates 2 to 3 times total this year.
Talking interest rates, the 30-year Treasury bond traded at the lowest level since April 2015. What's the outlook for the 30-year T-bond futures now?
So nothing has changed at all as the economy improves and actually accelerates. I would expect to see yields increasing and therefore futures prices declining. The bond market is the most susceptible to wage inflation, so I continue to believe that any rallies should be used as selling opportunities, especially at the long end. The 30-year bonds should be the weakest in the complex.
Now we talked about the volatility in the market last week, the biggest volatility we've seen in a long time. How should your typical investor react to that type of volatility? Is it something that they should sit on the sidelines and wait it out? Is it too quick to sell? Should they be paring back? What is your opinion there?
Well, I think the thing to do now is start thinking smaller as far as trade size. The volatility definitely means that there is the time now to be a bit risk averse. But as I said, nothing has changed. Continue to trade from the long side, but possibly in much smaller quantities.
Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.